Welcome back to your ultimate pit stop, Piston Pundit. Today we're putting the pedal to the metal on a geopolitical drama wrapped in steel, sovereignty, and $200 billion in gold. That's right. Germany and Italy are demanding their bullion back from the New York Fed, all as tensions rise under Trump's trade pressure and tariff rhetoric. For decades, European nations parked their precious reserves in U.S. vaults for safekeeping. But now, that trust is shifting into reverse. From Berlin to Rome, politicians and central banks are reconsidering whether Made in America still means safe and sound. This isn't just a vault story, it's a power play. Buckle up, gearheads. Here are the developments shaking the foundations of international finance. Legacy vaults and rising trust issues. Since World War II, Germany and Italy have stored much of their gold, totaling 5,804 tons, at the New York Fed, a legacy of Bretton Woods and Cold War trust. Today, Germany still keeps 37% of its 3,352-ton stash there, and Italy, 43% of its 2,452 tons. But Trump's comeback and his critiques of Fed independence have reignited fears about U.S. control. Germany's Taxpayers' Federation now warns that Trump's influence could compromise foreign gold holdings. CDU's Marcus Ferber agrees, calling the U.S. no longer the reliable partner it once was. What was once fringe chatter from AfD and gold bugs has hit the mainstream. Public broadcasters ZDF and ARD are questioning why Germany still relies on U.S. vaults. Bundesbank defends its position, citing routine audits covering 13% of U.S.-held gold and readiness to pivot if risk escalates. But sentiment is shifting fast. 95% of central banks now expect global gold reserves to rise, and 59% are keeping more gold at home, up sharply from 2024. The bottom line? Offshore trust is eroding, and legacy vaults are facing serious scrutiny. But trust issues are just the beginning, because in Europe, politics and gold have now collided head-on. Political firestorm in Berlin and Rome. Gold repatriation has shifted from fringe concern to political flashpoint. In Germany, AfD leaders like Alice Weidel and Peter Beringer long tied gold to sovereignty, with Beringer stressing that physical control matters in times of distress. But now, even voices from the left, like BSW's Fabio De Masi, argue there are strong reasons to bring bullion home amid global instability. Italy faces similar tensions. Prime Minister Giorgia Meloni once pledged repatriation in 2019, but in power, she's walked a fine line between nationalist ideals and U.S. diplomacy. Critics like Enrico Grazzini warn that keeping 43% of Italy's gold in Trump-era America is risky business. Germany's CDU is leaning in. Marcus Ferber and other mainstream conservatives now frame gold as a bargaining chip in tariff disputes with the U.S., particularly around steel and autos. The Taxpayers Association has pushed the issue further, calling for central bank hearings and parliamentary debate. Even CDU veteran Peter Gauweiler is questioning the safety of offshore storage. In both capitals, repatriation has become a flashpoint tangled in sovereignty, trade, and rising public skepticism, no longer just economic, but intensely political. Before we delve deeper, do us a favor and smash that like and subscribe button. It helps Piston Pundit reach more gearheads like you. Now let's shift gears from the political lane to the high-stakes challenge of physically moving the gold. Moving bullion is no Sunday drive. Repatriating nearly 1,930 tons of gold isn't just symbolic, it's a colossal logistical feat. Germany has done it before, moving 674 tons from 2013 to 2017, using NATO aircraft under tight military coordination, at a cost of €7 million. That playbook, nighttime flights, secure corridors, vault-to-vault handoffs, is still in place. Now, Germany and Italy are eyeing a much larger mission. $245 billion worth of bullion flown out of New York using IL-76 or C-17 aircraft over 8 to 10 weeks. Weekly 50-ton shipments would alternate between Frankfurt and Rome, all under NATO oversight. But before the wheels lift off, politics must clear the runway. Bundesbank officials tread lightly, calling the New York vault trustworthy, while quietly updating audit protocols. They insist any move must be part of a broader government and financial strategy. Italy's cabinet would need to approve budgets, diplomatic permissions, and military coordination. The risks? A visible repatriation might sour ties with Washington, or be read as a vote of no confidence in Trump's Fed. But if executed, it could drain New York's vaults by $245 billion, redefining global monetary norms. And while the airlift is one thing, the financial consequences of that much movement? That's where things really start shaking. Shockwaves in the system liquidity, rates, and fallout. Transferring $209 to $245 billion in gold isn't just symbolic. It creates real financial tremors. The immediate concern is liquidity. Such a large withdrawal could spike the Federal Reserve's reverse repo balances by $20 billion in a single week, straining short-term markets. Treasury yields could rise by 10 basis points, nudging up mortgage and corporate loan rates. If Germany and Italy sell around $18 billion in short-dated treasuries to finance the move, yields might climb another 5 to 6 basis points. This adds fuel to already rising federal borrowing costs, expected to jump from $659 billion in 2024 to $770 billion by 2026. For U.S. households, a small rate hike, say from 6.62%, could mean an extra $30 per month on a $350,000 mortgage or $380 annually, cooling the housing market. Auto loan rates would climb too, potentially slashing vehicle sales by 500,000 units and risking 10,000 auto jobs. Municipal bond yields could rise 30 BPs, slowing infrastructure investment. To cope, Washington might turn to gold-backed covered bonds or ECB swap lines, both risky. If gold repatriation unfolds, the U.S. could face immediate liquidity crunches and long-term fiscal strain. Still, short-term tremors are just the beginning. The long game is where this gets strategic. Global reserve shift. Is the dollar losing its crown? Beyond short-term shocks, gold repatriation signals a deeper shift in global finance. By the end of 2024, gold made up over 20% of global central bank reserves, nearly double its 2000 share. If Germany, Italy, and other Eurozone nations escalate repatriation, that figure could reach 25% by 2028. The ripple effect? Reduced demand for U.S. treasuries, potentially up to $800 billion, weakening the dollar's dominance. Economists warn this could push the neutral U.S. interest rate toward 3.5%, limiting the Fed's ability to manage inflation or stimulate growth. For everyday Americans, that means pricier mortgages and auto loans, squeezing buyers and raising the cost of credit. For global markets, it marks the beginning of an expensive dollar era, where financing U.S. deficits becomes more painful and foreign investors seek refuge in gold, not greenbacks. The risk is a feedback loop. Repatriation lowers treasury demand, raises yields, worsens deficits, and fuels further reserve diversification. With 43% of central banks planning to increase gold holdings and 95% expecting continued growth, the trend is clear. The dollar's safe haven status is slipping, and the U.S. may soon pay more to stay on top. With gold rising and the dollar straining, we're heading for the final lap. What does it all mean? Final drive. Dollar at the crossroads. Germany and Italy's move isn't just about shifting shiny metal from vault to vault. It's a flashing signal that old trust in U.S. financial stewardship is fraying. Short term, markets will feel liquidity shocks, rising yields, and consumer strain. Long term, we're watching the early signs of a gold-fueled power shift in global finance. This may be the clearest sign yet that the era of uncontested dollar dominance is nearing its end. Let's open it up to you. Do you think other nations will follow Germany and Italy's lead in reclaiming their gold? How will rising borrowing costs, especially on auto loans and mortgages, reshape everyday life? And do you believe gold is regaining relevance in modern finance? Or is this just political posturing? Let us know in the comments below. We want to hear your thoughts, experiences, and predictions. And don't forget to hit that subscribe button so you never miss a gear shift in global finance, car markets, or high-stakes policy showdowns. Thanks for stopping by Piston Pundit. Until next time, keep your engines running and your questions coming. You can now check out any of the videos on the screen. There's plenty more to explore.